Everybody, this is Rob Kientz, your host with the Freedom Report, and today we're going to get into economic analysis. Precious metals video will be later in the week. As I told you guys last week, I'm going to begin separating these out into more bite-sized chunks. It'll give a little bit more content throughout the week and hopefully get away from those hour-long videos that we do, because we know the viewership doesn't stick around, past that 30-minute mark. It's just the way that social media is today. But I think it also allows me to focus content where you guys may want it. Some of you guys love the economic report. Some like to focus on precious metals. Some like the guests I have on the program and some of the other topics that we do. So this is a continuation of that. Today, we're doing the economic report where I go over the data in the economy, and I've got an absolute ton of exhibits for you talking about the health of the economy. And at the very end, we're going to talk a little bit about program content, some housekeeping, just a minute or two. So stick around for that. For those of you who have been longtime viewers, I know a lot of people, my stickiest people, my guys and girls that watch, have been watching since I've been on for about 5 years. So that message is really for you. If you're new to the channel, it may or may not apply to you, but feel free to stick around anyway. Wearing the Make Silver Great Again hat, we'll talk about Guanajuato Silver, who is a miner who sent that to me at the end of the program. For you guys, not a paid promotion, but I like them. And I did a mine tour video. I'm going to show you where to look at that. If you're all interested in the mining stocks, stay tuned to the end. All right, we're a minute in and we need to jump into the presentation. So first, I'm going to do the markets. So right now, the Dow Jones is down about 135 points. This is as about 2:40 p.m. Central Time on September 10th, 2024. When I'm looking at the data, the S&P is up 18 points to 5489.64. The NASDAQ is up 125 points to 17009.94. And the Russell 2000 is at 2094.33, down 3.45 points. Overall on the markets, the bond yield curve inversion, the 2 and 10 year, after something like 792 days or whatever that number was, about 2 years, give or take 2 years, the 2 and the 10 year were in an inversion, meaning typically when you go to buy bonds, the longer term you buy a bond, the higher the interest rate to entice you to buy it, because you don't know what's going to happen 5, 10, 15 years from now. An inversion happens when the shorter term bonds actually have a higher interest rate on them to entice people to buy them. Why do shorter term bonds get higher interest rates at times? It's because people see immediate stress in the economy and we're expecting a recession. In other words, it is one of the most clean and effective recession indicators of all the indicators that we look at for recession. I'm going to show you another one here a little bit down the line when we go to Mishtalk's website. There's a really good one. But that 2 and 10 year is indicating that we're heading toward a recession. It uninverted, meaning the 10 year is appropriately priced at a higher interest rate than the 2. And usually when it uninverts, that means you're right smack dab looking at the recession. You're really, really close to it. Right now, the 2 year is trading at 3.607 and the 10 year at 3.648. So a distance of about 0.04-ish on the interest rate. That's important just because, again, recession indicator. So I wanted to report on that. Go into the cryptocurrencies. I know a lot of people don't like me reporting on cryptocurrencies. It's been a gold silver channel for a long time, but understand that I look broadly at the market and there's a ton of money in cryptos. Bitcoin's over $1 trillion market cap now. It'd be foolish for me not to look at it. Also, for a lot of people, Bitcoin is a barometer of how they feel about the economy and the currency. That's why I report on it. Bitcoin right now is up about $942. It's trading right now at 57,881 and 77 cents. Ethereum is at 2377.16. It's up about 32 points on the day. Litecoin is up about 32 cents to 61.62. XRP is unchanged today at 54 cents. That one's not incredibly liquid. About to report on it because for a long time people thought that was going to be the rail system for the global central bank digital currencies, although it looks like that may not be the case now. In any case, we do like to report on that and let you know what is going on there. And that's about it for the cryptocurrencies. On to the economic data. Last week, a ton of data. I'll get to that in a second. This week, though, we've had something on wholesale inventories are up 0.2%, which just means people have bought more wholesale stuff. That's in anticipation of making stuff that the consumer will actually get. It's really sort of a flatline number. I'm not too concerned about it. Consumer credit, I'll get to here in a moment. Let's look back next week. We had a lot of big data. After the Labor Day holiday starting on Tuesday, the S&P U.S. Manufacturing Purchasing Managers Index which is an indication of how well the manufacturing sector is doing, was slightly down from a 48 reading to a 47.9. The key here is it's below 50, which means we're in not growth, but shrinkage. So our manufacturing sector has been getting slammed all year long. It's continued that trend. Construction spending right along with it is down 0.3%. Manufacturing index, the ISM manufacturing index, is at 47.2, slightly up, but not much over last month at 46.8. Job openings fell to 7.7 million. We'll talk a little bit more about that in a future video. We're going to go over jobs in detail. That's what I mean about these breakout videos. I'm going to take jobs and just do a video on jobs. Moving forward, auto sales fell from 15.8 million last month to 15.1 million, although factory orders are up slightly 5%. Not too bad. Getting on the employment numbers, the first week of the year, the first Wednesday and first Friday, we get the unemployment numbers. The Wednesday, we get ADP, or now it's Thursday. ADP employment was up 99,000 jobs. That's not much. Last month, it was 111, and economists expected 140. It means we're not creating as many jobs. And again, when I get into the jobs data in a separate video, I'll go over that in detail and break that down for you. U.S. productivity rose slightly to 2.5%. Initial jobless claims fell a little bit. So the job data is a little bit mixed, but there aren't enough jobs and not as many people are employed is what you want to know, because the unemployment rate is at 4.2%. Now, they did fall 0.1% from last month, but given the types of jobs and things, it's not a move. We're not employing more people overall. That's what you need to know. That U3 number that they quote all the time, that 4.3, 4.2%, it's really an indication of the current job situation, not the extended people have been out of work for more than a year and are giving up and that type of thing. Those numbers are ballooning, but the short-term joblessness is about even from where it was last month. Hourly wages, however, have gone up 0.4%, and year over year, they've gone up 3.8% in a year, meaning workers are costing about 4% more than they were last year, but they're not getting those types of raises. That's the economic data. Here's a news story that really bugged the heck out of me, and I'm going to rant on this one. Listen to this from CNBC. The Federal Reserve unveils a toned-down banking regulation in victory for Wall Street. Listen to this. This is on the backs of Basel III and what they call the Basel Endgame. If you guys have been watching my program for the last several years, at least 4 years, I've been talking about Basel III. I was one of the first people to report on the IMF working paper and Basel III of anybody in the alternative media community. Basel III basically is a set of regulations for tightening up the banking system. In all intents and purposes, there's a lot that goes into it. And one of the things was increased reserves. But look at what the Fed's doing compared to what Basel III wanted. A top Federal Reserve official, according to CNBC, on Tuesday unveiled changes to a proposed set of U.S. banking regulations that roughly cuts in half the extra capital that the largest institutions will need. Introduced in July 2023, the regulatory overhaul known as the Basel Endgame would have boosted banking capital requirements for the world's largest banks by roughly 19%. Instead, officials at the Fed, the Office of the Comptroller of the Currency, and the Federal Deposit Insurance Corp have agreed to resubmit the master proposal with a modest 9% increase to bank capital, according to prepared remarks from Fed Vice Chair for Supervision, Michael Barr. They're cutting in half the increase in reserves that banks need. Now, we know the problem that happened in 2008 and 2009, the banking crash, and what happened last year in the spring was that we didn't have enough reserves. And when the value of the balance sheet assets go down, namely the bonds, because interest rates are going up, which forces the bond face value to go down in the opposite direction, it causes all sorts of problems with banking balance sheets. And to offset that, things like cash, gold, silver, whatever other asset can help offset that and maintain bank liquidity. Well, what this is telling me is the Federal Reserve doesn't believe that banks can increase their liquid capital requirements by 20% because it's not in the system, which is why they're doing it, which tells you the health of the U.S. banking system. It is not healthy. According to CNBC, introduced in July 2023, the regulatory overhaul known as Basel Endgame would have boosted capital requirements for the world's largest banks by roughly 19%. Instead, officials at the Fed, the Office of the Comptroller of the Currency, and the Federal Deposit Insurance Corp have agreed to resubmit the massive proposal with a more modest 9% increase, according to Fed Vice Chair. This change comes after banks, business groups, lawmakers, and others weighed in on the possible impact. Quote, the process has led us to conclude that broad material changes to the proposals are warranted, Barr said in the remarks. There are benefits and costs of increasing capital requirements. The changes we intend to make will bring these into balance. The earlier version brought howls of protest from industry executives, including JP Chase CEO Jamie Dimon. But big banks are the only ones to benefit. Regional banks with between 100 billion and 250 billion in assets are excluded from the latest proposal, except for a requirement they reorganize unrealized gains and losses. The journey to improve capital requirements since the global financial crisis has been a long one, and Basel III Endgame is an important element of this effort, Barr said. The broad material changes to both proposals that I've outlined today would better balance the benefits and costs of capital in light of comments received and received in the capital framework. So in other words, translation, the big banks looked at it, decided they didn't want to do it because it would affect their profits, and they probably don't have the money to do it anyway, and so they said a big fat no. And so the Fed backed down and cut the liquidity increase requirements by half, which is absurd. Okay, on to news. Macy's set to close 55 stores by end of 2024, according to Retail Wire. Macy's has announced that it's closing a total of 55 stores by the end of 2024, and the faltering brand's ongoing effort to revamp its business. According to the Daily Mail, the company originally intended to close 50 underperforming stores by the end of the year, part of the 150 total locations that will close in 3 years. However, it now plans to close 55 before 2025. The locations of the shuttering stores have not yet been announced, but speculation is abounding that stores will include a location in New Hampshire, Michigan, Tampa, Florida. These are reported set to close after the winter holidays. The biggest things that have gone wrong at Macy's are quality of the stores and the product assortment, global data retail analyst Neil Saunders said to the outlet. And so over the years, customers have deserted it. Sales have tumbled and store productivity has gone down. All the metrics have gone in the wrong direction. Well, maybe so, maybe not. We have a report from Goldman that says the thrift trends outperform amid consumer slowdown. Listen to this. However, they pointed out, the Goldman report, within this, off-price and thrift trends continue to outperform other consumer discretionary retailers, such as Macy's, while department store and specialty retail traffic results have been fairly choppy, such as Macy's. Athletic brands such as Lululemon and Nike Factory Store have underperformed. People can't afford brand names anymore, and they're going to stuff like dollar stores, and the department stores are failing because they don't have money. And any brand name outlets and things like that are starting to get into trouble. So the premium brands are getting into trouble, and the premium stores are getting into trouble, and consumers are shifting their patterns to cheaper stuff. And the rest of the program, I'm going to show you a bunch of visuals that illustrates what's going on in the economy, and I think this will help you guys see it in pictures. Here from Visual Capitalist is the purchasing power of $100 by state. Less valuable is in the lighter color, more valuable is in the darker color. My home state of Texas, we get $103 in purchasing power. Even though things have inflated here, we're still better than average across the union in terms of what we can buy for $100. California is a dumpster fire at $88. New York is a dumpster fire at $92. New Hampshire is a dumpster fire at $92. And New Jersey's one of the worst at $91. Washington at 90, Oregon at 93. You'll see that the Midwest does the best and the South does better. A lot of the more liberal states, and I mean economically speaking, liberal economic policies are doing worse. In other words, with all the costs of all of those programs leads to increased inflation. And with that increased inflation, the dollar doesn't stretch us more. And if you look at a population movement chart over the last 10 to 15 years, you'll notice that some of the deeper red states are getting the population moving in, while some of these light pink states with lower purchasing power for the dollar have people moving out. New York, California, even Florida, other states which are very liberal, Colorado, liberal economic policy, people are fleeing because the cost of the liberal economic agenda is rising faster, so the money stretches less, so people are moving to be able to survive. This is a nice visual representation. Money is less valuable in California. California has the lowest purchasing power, while Arkansas has the highest. And you can see it in a table right here. National average 103. So Texas right at the national average where I live. Well, let's talk about food. Let's talk about people's ability to buy stuff. Here at Statista, U.S. food insecurity is on the rise. The share of households in the U.S. classified as food insecure from 98 to 23. You can see that it's on the rise. The graph is ticked up. And all households and households with children, food insecurity is on the rise. People can't feed their kids. They can't feed their families. Why? Because of inflation, because the purchasing power of the dollar is falling. And what do you bet? If you looked at some of these states with lower purchasing power of the dollar, that they would be the ones with the highest food insecurity. I can almost guarantee you that's the case, because when everything costs more, You can't buy as much food. It's just simple, easy 101 budgeting. When everything goes up, things have to be cut. And that includes going to retailers like Macy's and buying food. It's all over the data. We're in recession. We're in recession. We're in recession. People can't afford things. We saw it with the yield curve inversion, the 2 and 10 year. I talked about it before. We'll get to another key recession indicator, which says we're in a recession right now here in just a moment. Moving on to another story about consumers on Zero Hedge is a report about credit collapse. The title is, "In Last Hurrah, Credit Card Debt Unexpectedly Soars Despite Record High APRs or interest rates as Savings Rate Hits a Record Low." And I'm just going to go down to the last couple of charts. Here's the personal savings rate. You can see that that rate is totally cratering. There we go. Personal savings rate is going down. But if you look at this chart, rising credit card debt in red, falling savings rate. Rising credit card debt to buy what? Food, because prices are going up in a lot of these states, and personal savings rate is low. What does that mean? We're in a recession. And the charge-off ratio for Discover and Capital One credit cards is way up. It's been up since 21, since the restart of the economy, but it's up much higher than it was dating back, looks like about 9 years on this chart. The charge-off ratio is going up. Consumer credit balances are going up. At the same time, people can't afford food, and the dollar doesn't stretch as much. Very easy to see what's going on economically. Well, here is the release of consumer credit outstanding. These are all in billions, so the final numbers are going to be in trillions. If you look at total outstanding, revolving and non-revolving, in July, we had over $5 trillion in outstanding debt. 1.4 was revolving, 3.7 was non-revolving. Non-revolving are things like mortgages and bigger loans. Revolving is something where you have a monthly payment, you can pay it off type of deal. Credit cards, bank cards, gas cards, any type of revolving credit, Macy's store cards, it's in there. So, and it went up in 2019, we were at 4.192. So we've gone up $1 trillion in about 5 years, $1 trillion in about 5 years in terms of what people are putting on their credit card. And the APRs are much higher, as we got in this report. The annual percentage rate of credit is higher. So it's higher and the balances are higher, which means the monthly payments are way up because you've got more on the credit card and you're paying more as an interest rate. So the credit card payment is a much bigger piece of the pie and what people can afford. And that's why food insecurity is going up, because people don't have money to buy food. Now on to a recession indicator. This is on Mish Talk's website. Thank you, Mish, for putting this out. Some people have talked about recession indicators like the SOM, the McKelvey, the PMES, the vacancy rate. Basically, it's looking at measures of unemployment. So McKelvey is two statistics wrapped into one, and then they look at job openings. So you take those three and smush them together, and he's come up with an index, or they have come up with an index, a modified McKelvey recession indicator with no false positive, no false negative. In other words, this always tells you whether there's going to be a recession with no false positive, no false negative. Think of the 2 and 10 year yield curve inversion. No false positives there. When it says recession, you get a recession. This is a second one that when you go graph it over time, all the way back to 1953, it's called every recession with no false positives and no false negatives. And that's this one. And it's saying we're in a recession right now. A modified McKelvey recession indicator with no false positives or false negatives on jobs data, on 3 measures of jobs data smushed into a chart. You don't need to know the details. You can read the article if you want. But when you put those 3 together since 1953, and it's had no false either way, that it suggests we're in a recession now. Why are we in a recession? Consumer credit's up. People can't save anything. They can't buy food. And the purchasing power has gone down in many states. We're in a recession. People can't afford stuff. That's it. Going on to China. China faces worst deflationary streak since 1999. Its prices in the longest decline since 1999. Let's blow this up for you. This is a deflationary recession indicator. China's in recession. It wasn't just the last few years, their real estate. Although real estate's in recession, if you look at their mortgages, their outstanding mortgages shrink. Why? Because people can't afford homes. What's the number one asset people buy in China? Homes. Well, let's talk about China. So China's in bad shape, but the one thing China has done is dominate the supply chain for strategic metals. These are strategic metals and clean energy transition. So if you're getting to EVs or whatever, these are important to the EV movement, to the clean energy movement. They're also key minerals for other things, like rare earths is used more in clean energy. It's used in a lot of things, military applications, advanced steel, stuff like that. Lithium is used in battery technology. Cobalt is used in tons of things. It's used in steel production, used in tons of things as a complementary element. And graphite's used in battery technology. It's also used in many other things. Look at who dominates the share by country. China's in there. China's in every one of these. China, China, China. They're dominant in what are going to be the next round of critical minerals in the world for many functions. Which countries hold the most critical reserves? Graphite, China is up there. Rare earths, China is up there. China's in two of these, a Democratic Republic of Congo, I think, DRC, and then Chile for cobalt and lithium. But look at who does the processing. Top country, China. If you want to run a modern economy, not just a clean economy, but you want to run a modern economy, run modern tech, run modern military, you have to go through China to get it processed. If China decided to cut off the West and the US from processing these things, our economies would crash. China is at the forefront of what is going to be the economy going forward in terms of mineral production. So even though right now they're going through recession, they set themselves up to be at the front of the next post-recession growth phase. And that, I think, is where China is going to eventually surpass US as the world's largest economy because they're positioned better. Where's the US in all this? US is not even on this chart of critical minerals. We're not anywhere on it. Well, we're here in rare earths. So we can do some of our own production. We can't process it very much, but we can produce some of it. But that ain't enough. Where else is the US on this? Nowhere, nowheresville. All right, that's your economic report. I wanted to go and point out a couple of things. I did this interview with Stephen Hochberg last week. It was Elliott Wave interview. A lot of people are confused. I had somebody at church that follows me. It says, I don't understand Elliott Wave. Elliott Wave is just a mathematical look at data points on a chart. Let's say you're looking at a gold chart and you're looking at all the price points. Well, there's a million decisions that went into each one of those points on a gold chart. It's everybody's buy sell decisions, the derivatives market, a little bit of the physical market, a little bit what's going on with fundamentals in the economy, all put into like a gold price chart. All Elliott Wave does is take that, it looks at the patterns, and it says this is what we think is going to happen next over long periods of time. Now, in math class, when I was in my bachelor's, I did a business degree. It was a hybrid business with MIS, which is tech. And in one of the classes, I took calculus, business calculus. And so one of the problems they had us looking at was populations. Use a mathematic equation using calculus, advanced math, to anticipate the population of deer given these two factors. So we can look at populations, we can look at decision-making with math and almost tell you what's going to happen. That's why Elliott Wave chartists look at the economy, because they're looking at markets and looking at human decision-making. And there are patterns in human decision-making. I talked about patterns. I've talked about conjunctive waves. I've talked about nation-state cycles. I've talked about all these other shorter-term economic trends over the last few years. Just know that you can apply math to it. And this guy's applied a lot of math to it. And he's calling a huge stock market correction. He's calling the next gold bull. He's also saying real estate's not going to do well, commercial and residential, although land may do okay. And we talk about that in the video. You don't have to understand the math behind it, but just know that math is a predictor of human behavior. And Elliott Wave is one of the most successful. It's not 100% perfect, but when you get an Elliott Wave that is this much in line as what he's seeing, that's why we think there's going to be a huge stock correction and commodity cycle is going to come, and then gold and silver are going to lead that commodity cycle. That's a good one. Another video I wanted to recommend is go watch The Road to Serfdom is Paved with CBDCs. I've got two experts on there, one from the Brownstone Institute, one is former military, worked in intelligence and military, and has been studying this. And we have a really good roundtable of what's coming with the central bank digital currencies. Anybody that's interested in sound money, it's interested in the future of the monetary system and your gold, silver holdings and freedom from any sort of financial tyranny or suppression, you want to watch this video. It's really, really good, and I want to point you guys to it. Okay, who sent me the Make Silver Great Again hat that I have on? That would be Guanajuato Silver. And you can go to their website, gsilver.com, and look at all their press releases and their projects. If you want to see a video 2 years ago, this is the name of it, visiting a 500-year-old silver mine in Guanajuato, Mexico. I did a video on it with a couple of friends of mine who went down there, and they do newsletters and things, and we did this tour. So this video actually takes you into the mine.
Half this year from Soviet area.
All right, so we got people telling us what's going on, doing drawings. We've, I've got pictures of where their mine is. We're actually in the mine where we drive down into it. In fact, here's the truck where we're driving down into the mine. I've got that on film. I've got their processing plant on film, all that kind of stuff. I've got where we're looking at the tailings or the drill results, or not tailings, the drill results and how much silver they've got. I've got geologists on here if you're interested in all. Now, this isn't a paid deal, but they did send me the hat to get, they wanted to get on the channel, but I really appreciate them. They're really good. I think they have a good project, and I've got that video. If you're interested in the mining sector at all, and that's something that you think you may want to take a look at, Guanajuato, I think it could be a potentially good play. With the silver and gold stocks starting to rebound a little bit on this recent raise in prices, it may be just about time where the miners are going to start to do well again. I think that they're probably in an uptrend. Now, they haven't really popped because silver hasn't popped yet, but you're seeing some movement in the mining stocks. It's now time to start talking about them again. Guanajuato, you could do worse in Guanajuato as a potential target. Again, not a paid sponsor, but I like the company, wanted to bring them to you, and thanks for the hat. It's a great hat. I wear it around town. People are like, that's a MAGA hat. No, it's a Make Silver Great Again hat. And it's a great conversation piece for talking to people about gold and silver. All right, that's about 26 minutes long. That's a nice, good economics report for you guys. Gold and silver will be broken out later in the week. And then we're going to do one on jobs, immigration. We're going to do that type of video later in the week as well. Stay tuned for that one. There's so much data about what's going on, about immigration and crime that I'm getting into. You want to stay tuned to the channel for that one. This is going to do it for today. This is the economic report. Stay tuned for the gold silver report later in the week. And then I'm going to do an immigration and job report all in one. You guys don't want to miss that. Until next time, Rob Kientz with the Freedom Report.